Hello everyone, and welcome to Nettle, the best platform around for distance learning in business, finance, economics, and much more. My name is Sava, and today we're going to discuss a very important concept in terms of risk management, banking, and asset management, which is duration. Well, you all know that banks face interest rate risk. Well, the easiest way to kind of conceptualize it would be if you have a variable rate loan or have your liabilities denominated at a variable rate. Well, if the rate changes, your net interest income can change, and that is what's captured by some simple models such as the repricing gap. Then you might wonder, why won't banks just fix interest rates on all of their assets and liabilities and be kind of immune to this interest rate risk in terms of net interest income? Well, there is a hidden peril in that interest rate risk concept. Well, imagine that you have fixed the interest rate on your asset that has a maturity of 5 years, for example. What happens is, well, imagine that's a bond and you're holding a bond and you're receiving fixed coupons every single year, and then you'll receive a fixed principal at the end of your investment period. What would happen if the interest rates in the overall economy move up or down? Well, it wouldn't affect your coupons, obviously, but it would affect the fair value of this bond. It would affect the price at which you can sell this bond that you're holding on the market. Well, why should you care about your fair value of assets and liabilities changing with the changes of interest rates? Well, imagine that there is a sudden interest rate spike and your bank is holding long-term assets and short-term liabilities. Well, the long-term assets would be much more responsive to discount rate increases, as well the changes in discount rates is more impactful for cash flows that are further away in the future. That's intuitive, and there could be a very obvious mathematical representation of that. And the fair value of those assets would drop a lot, and the fair value of the liabilities that are generally more long-term, that are generally more short-term. Remember that banks undertake this maturity transformation and they create liquidity out of nowhere, and that's why we all love banks and why they are essential for the functioning of the financial system of providing loanable funds to businesses and so on and so forth. Well, if that interest rate hike happens and you have fixed the rates on your assets and liabilities, if the fair value of your assets drops a lot and the fair value of your liabilities drops a little, then it would mean that the economic value of equity of the bank can potentially go negative. What it would mean is that all of the creditors of the bank, so most likely your everyday bank depositors, would understand that the bank cannot sell all of its assets to maintain the value of its liabilities. What it means is that they would want to be the first to take their money out of the banks. That would just induce a run on the bank. So as the fair value of banks' assets is lower than the fair value of its liabilities, then all of the bank's creditors, so depositors, lenders, and so on and so forth, would have an incentive to immediately rush at the bank and take their money out. And as everyone has this incentive, some of the creditors would fail to extract their money out of the bank. So that can cause the bank to collapse and pose systemic risk threats to the overall financial system, to trust, and so on and so forth. That's why it's very important to manage interest rate risk in terms of the economic value of equity. It's very important to model how fair values of fixed rate assets and liabilities respond to changes in the discount rate. And that's where the duration model comes in handy. Obviously, you could just model this as a first order approximation in terms of maturity gaps, but we can see, and this is a very handy example here, as how assets or liabilities with exactly the same maturity, but different structure of cash flows, different cash flow schedule, can differ in terms of duration, and therefore their sensitivity to rate changes tremendously. So, first of all, let me explain what duration is. Well, duration is just a time-weighted discounted cash flows. So time-weighted present values of the cash flows that represent a particular asset or liability. So for example, let's assume we have a 5-year bond, and with bonds, the schedule of cash flows is very simple. You have coupons that are paid regularly, so annually, semi-annually, quarterly, most commonly, and at the very end, so at maturity date, you are getting paid the final coupon plus the principal. So what you would do is you would weigh the present value of the cash flows you receive from a bond by their respective maturities. So for example, if you receive a particular coupon at the end of year 1, you'll multiply it by 1. If at the end of year 2, you would multiply it by 2, and so on and so forth. And then at the very end, you'll multiply the fair value, the present value of the principal plus the fair value of the last coupon by the maturity of the bond. So for example, by 5. And then you'll just divide it by the sum of the fair values. So that's the time-weighted average of present values of the cash flows. So that's all there is to duration. And let's figure out what would be the duration of a hypothetical bond with a principal of £1,000, the coupon rate, so interest rate of 6%, given the fact that the discount rate is 6% as well. So the duration would allow us to estimate how sensitive is the fair value of such a bond to movements in the discount rate. Because remember, we assume that the bond is fixed coupon, so if the interest rate change, the coupon is not affected, but what's affected is how valuable are those coupons far away in the future with respect to current time value of money. And let's assume it's a 5-year bond, so either we have issued it or someone else have issued it at the 31st of December 2014, and the maturity date is end of December 2019. So first of all, given the fact that the structure of the cash flows of the bond is the simplest, we can say that no principal is paid all the way until the end of year 5. And at the end of year 5, the principal paid is just the whole principal of the bond. That is clear. Now we need to remember that the interest charged on any fixed income asset or liability is based on the outstanding principal. So at the start, obviously, the outstanding principal is equal to the total principal of the bond, and then at the end of each year, the coupon is charged based on the outstanding principal of the bond. So we multiply the outstanding principal by the interest rate, and we lock that because the coupon rate is fixed through time and it doesn't change irrespective of changes in interest rates or time. And now the outstanding principal at the end of the following year is obviously the outstanding principal at the end of the previous year minus whatever principal we paid in the previous year. Obviously, in case of the bond, the principal remains the same. The outstanding principal remains throughout the lifetime of the bond, and the interest is always being charged on the overall principal. So accommodating for this logic, we can just bottom right click it all the way down and see that in case of the bond, every single year, if we assume that the coupon is paid annually, we are paid £60 in coupon, and at the very end, at maturity of the bond, we are paid £1,000 in terms of principal. And obviously, as there is nothing more, nothing less to the cash flow structure of any bond as the interest plus principal, we can accommodate that in our cash flow formula by just adding the interest and principal that the issuer of the bond is going to pay us. So again, the cash flow is just the interest in the first 4 years, so coupon is paid at the end of each year, and at the very end, at the end of year 5, so at maturity, we're paid the very last coupon plus the principal. Now we need to discount those cash flows using an appropriate discount rate. So we're taking the cash flow and divided by 1 plus the discount rate, which is again 6% in that case. We lock the discount rate because it stays the same, and we raise it to the power number of the year. So we're discounting by larger and larger factors as the time goes on, because cash flows that are very far away in the future are less valuable than the cash flows that are closer to the present day because of time value of money again. That's a very simple concept that's applied in all areas of finance. So we reinforce this formula, discount those cash flows, and we see that in total the sum is equal to the principal of the bond. Well, unsurprising, as the coupon rate, the interest rate, is the same as the discount rate. That's exactly what you would expect in that case. And now we need to weigh those discounted cash flows by the respective time that has passed from the present day until the day we receive those cash flows. So again, we weigh present values by time, and that's exactly what duration is about. So we weigh it, so multiply it by the number of the year, and bottom right click it all the way down. Now we can calculate the duration of the bond. So we just need to sum up the weighted discounted cash flows and divide them by the sum of the discounted cash flows as there are. And we see that the duration of this bond is 4.47 roughly. Well, we can see that it's lower than the maturity of the bond. Obviously, maturity is the upper bound on duration. The duration of any asset liability would be equal to its maturity if and only if all of the cash flows are received at maturity. Sometimes that happens, it's not that common, but for example, you can have zero coupon bonds that are issued at a discount in terms of their principal, and then only the principal is paid back at maturity date. In that case, the maturity and duration of that type of a bond would be the same. But that's a very fringe case, and most of the time the duration is lower than a maturity. And the duration is the lower, the closer the cash flows are to the present day. In that case, most of the cash flows did occur remotely in the future, so closer to the maturity date than to the present date. And that's why the duration of this bond is close to 5, ultimately. To understand now how to apply duration in terms of interest rate sensitivity of the fair value of this bond, we need to introduce modified duration. Modified duration is a better estimate of sensitivity than duration is. So to move from duration to modified duration, we'll just need to divide the duration by 1 plus the interest rate. And that's all there is. If we apply that, we see that the modified duration is roughly 4.21, and 4.21 is basically the response of the fair value of the bond to the interest rates. So we can estimate that if the discount rate increases 1%, then the fair value of that bond will decrease by 4.21%. Now let's try and see whether that's true. So the fair value of the bond would be just the sum of the discounted cash flows, isn't it? So obviously when the interest rate and the discount rate are the same, the fair value and the principal are equal. But again, bearing in mind that's the modified duration, that's the estimate of interest rate sensitivity. Let's see what happens if we increase the discount rate to 7%, so increase it 1%. We would assume that the fair value of such a bond would fall by approximately 4%, or slightly higher than 4%. And that's indeed what happens. The fair value of the bond fell from £1,000 to £959. So it fell 4.1%, slightly less than what was anticipated by modified duration, but that's due to convexity. Modified duration is just a linear approximation of this relationship. It's decent enough when your interest rate movements are not that wild, and it's also a conservative estimate. It always exaggerates the decreases in fair value given a particular increase in interest rates. So that's why just going with a linear approximation might be reasonable in that case. If you would like to go all the way through convexity and the nonlinear relationship between discount rates and fair values of fixed rate assets and liabilities, let me know in the comments and we can go through that in future videos perhaps. So in case of the discount rate, let's still assume it's 6% again. We just reinforce that duration is a decent approximation, modified duration, decent approximation of interest rate sensitivity. Now let's figure out whether we could have gotten away without estimating all of this cash flow schedule and just implemented a simple concise formula in Excel. Well, turns out for bonds, and for this particular cash flow schedule, when you have coupon plus principal at the end, there is a formula in Excel that allows you to estimate it concisely. And this formula is just called duration. And in case of this formula, you need to input two dates that are basically the issuance date and then the maturity date. You'll need to input your coupon yield, so basically that's the interest rate here. Then you need to input the yield, so that's the discount rate here. And then you need to input the frequency, whether the coupon is paid annual, semi-annually or quarterly. So in that case, to make it comparable with our own calculations, let's assume that the coupon is paid annually, so put 1 here and enforce the formula. And we can see that the output that Excel has given us in terms of duration is exactly the same than the duration we have calculated for the bond with annual coupons using discounted cash flows. But it turns out that bonds are not the only assets banks hold. Most of the time, the main type of assets banks hold is their loan portfolios. And very rarely, loan cash flow schedules are reminiscent of that of bonds. Most of the time, in terms of loans, so when you have a mortgage that you have to repay, or a consumer loan or a commercial loan, what happens is that either you negotiate with the bank that your principal is paid equally, so every single month you are not only charged interest, but you also have to pay equal proportion of the overall principal of the loan, or you negotiate that every single month, for example, every single year, you pay equal cash flows. So you try to repay your principal plus interest that's charged on outstanding principal in equal installments alongside the lifetime of the loan. So let's implement those two types of logic in terms of the cash flow schedule and see how they affect the duration of those assets, those loans. And what does it mean for the interest rate sensitivity of banks' loan portfolios? So if we assume that we have a loan of equal principal with the same interest rate, with the same maturity, but with principal paid out equally over the lifetime of the loan, well, first of all, to accommodate for that, we'll need to specify that the principal paid every single year out of those 5 years is just the overall principal of the loan divided by 5, because we've got 5 years. So it means that every single year we would repay £200 worth of principal to our bank. So that's how we will repay all of the £1,000 of principal alongside across the lifetime of the loan. Obviously, the outstanding principal at the very beginning would just be the 1,000, so the initial principal, and we'll be charged the interest based on the fixed interest rate on the loan times the outstanding principal. And again, the outstanding principal at the end of the next year would be the outstanding principal at the end of the last year minus the principal that we paid. And that's all there is. We could apply the same logic and see how this structure of the cash flow statement, the cash flow schedule that we can negotiate with our bank allows us to smoothly repay the principal alongside the lifetime of the loan. And we can see that at the very end, there is no principal left to be repaid because we have £200 outstanding. We get charged £12 of interest on it, and we immediately repay all of the principal that's left. Now we need to bear in mind that the cash flow that we pay to the bank or the bank receives from us is the interest that they charge on the outstanding principal plus the principal that we pay, and bottom left click it all the way down. And in that case, we can see that the schedule of the cash flows is very different from what we had in terms of bond. So in terms of the bond, we had a very high cash flow at the very end of the lifetime of our asset. So at maturity date, we were paid the last coupon plus the whole principal. In that case, the principal payments are the same, and the interest payments decrease with time as outstanding principal also decreases with time as we gradually pay it out. So if we apply discounted cash flows again here, the logic is extremely similar. So the cash flow divided by 1 plus the discount rate, and we log the discount rate and raise it to the power of the year. Then we bottom right click it all the way down and see that still the sum of the discounted cash flows of this this equal principal payment fixed rate loan, the fair value of it is still equal to £1,000. So to the principal, is just because again the interest rate is equal to the discount rate, but the interest rate sensitivity of this asset would be different than that of a bond. And to figure out how and why, we'll need to again weigh the discounted cash flows by the respective numbers of the year, and then apply the duration formula. So the duration formula again is just the sum of the time-weighted discounted cash flows divided by the sum of the discounted cash flows. Having applied that, we see that the duration here is 2.78. So it's almost twice as low as the duration of the bond, and unsurprising because, well, there are a lot of cash flows that are very close to the present date. Actually, the cash flows at the start are much higher than the cash flows at the end. So that's what brings duration much nearer to the present day. That's what makes it much lower than the maturity. And that's actually what is very attractive to the bank, because then the value of this loan portfolio, if they negotiate a cash flow structure like that, would be much less responsive to interest rate changes, rather than if the banks decided just to hold a bunch of bonds or negotiate loans with the repayment of the whole principal at the very end. So that's why one of the reasons why banks opt for a cash flow scheme more like that than something like that. If we consider the modified duration, we'll just need to divide this duration again by 1 plus the interest rate, and see that the fair value of this loan will decrease approximately 2.63% if the discount rate increases 1%, and vice versa. If the discount rate decreases 1%, the fair value of the loan will increase 2.63%. So the final example that we'll consider is the most difficult of the three, but it's by all means the most frequently used. When you negotiate with a bank that you take out a loan and there is a fixed interest rate, but your interest rate and principal payments are designed in a certain way so that the cash flows, so the amounts that you need to pay to your bank at the end of each period, so here at the end of each year, are equal. To figure out what is the amount of principal, or rather what is the amount of the cash flow that you need to pay to the bank, so total interest plus principal, well, you need to apply the annuity formula. So here, this formula tells you if you want to spread out the present value of a particular asset given a particular maturity and discount rate or interest rate across a certain maturity, the relationship between the present value and the cash flow should follow this particular formula. So we've got the present value of our total asset. So the present value of our loan, if the interest rate is equal to the discount rate, should be equal to £1,000. So we can extrapolate what the equally spread cash flows should look like if we negotiate something like that with our bank. So what we need to do is we'll need to take the principal of the loan, multiply it by the interest rate, and then divide it by the numerator of this ratio. So divided by 1 minus 1 plus the interest rate to the power of minus maturity, so minus 5 years. And it will give us that the cash flows should be equal to £237.40 every single year. And we can apply it accordingly and have those equal cash flows spread over 5 years. Now we can reverse engineer what our interest rate and principal payments should be to provide for that cash flow structure. So first of all, the easiest way to go would be to say that, well, at the end of the first year we haven't paid anything yet, so our outstanding principal is 1,000, and will be needing to be charged 6% on the outstanding principal. That doesn't change. But now we know the interest that we need to pay, and we know the total cash flow. So as well, because our cash flow is just interest plus principal, our principal is just the total cash flow minus the interest that we've been charged. So that's how we can reverse engineer the amount of principal that we can repay at the first year. And then we can carry on forward with exactly the same logic. So outstanding principal at the end of the second year is outstanding principal at the end of the last year minus what we have paid already. We get charged every single year based on the amount of principal outstanding, and then we see how much principal we have to repay even on top of the interest charged, by just subtracting the interest charged from the cash flows that we figured out from the annuity formula. And by applying this formula all the way to the very end, we can see that all evens out. At the very end, we have just enough to repay all of the outstanding principal in the last installment. Now we can just discount those fixed cash flows. So again, apply 1 plus discount rate and log that to the power of the number of the year. Again, they sum up to £1,000. Weigh them and figure out the duration. So here we can see that the duration of the loan with equal cash flows compared to the duration of the loan with equal principal is a little bit higher. Unsurprising, because, well, here cash flows are more spread out to the present day, and here they're just evened out across the whole lifetime of the loan. That's the logic why that happens. And if we look at modified duration, we just need to divide it by 1 plus the interest rate, and we can argue that the fair value of that type of the loan will decrease by 2.72% if the interest rate, the discount rate, increases by 1%, and vice versa. And that's duration, and how to figure it out for various types of assets with various cash flow profiles, and how it's different from maturity as the first order approximation of interest rate sensitivity. If you are more interested in how to measure and manage interest rate risk in a bank, or interested in the mathematical specificities of duration and the interest rate sensitivity of various assets and liabilities, let me know in the comments, and we'll dig deeper into that in the future videos. Thank you very much, and stay tuned.